Hey guys, welcome to this episode of my trading journal. My name is Mazam CB here at FX Link, and I'd like to welcome you back again. Today I'm gonna go through and pick off where Offense left off. So if you feel behind, please I urge you, watch it over and over and over again and keep on learning. If you feel like you get it and understand it, please continue off with this part of the video. Now, I'd like to show you, I'd like to start off by telling you what the internet doesn't tell you. Actually, the information is there. It is there. However, it takes a whole lot of research and a whole lot of searching, basically, to figure out that first, professionals make 3 to 5% return on investment monthly. Now, how do they do that? How do they generate such returns monthly? Some of you might say, well, Mandla, that's a small amount of profit. But if you could take a step back and then do some calculations, you would see that 5% is a large amount of profit. How is it so? Well, if you could say 3% times 12, how much would that give you? Probably 36%. So if you have generated 3% consistently each and every month, and yearly, that would have to mean that you have generated 36% of your returns. So it depends on the type of capital you have. So how much do they risk if they return 5%? Logic would have to kick in, and you'd have to reason and understand that they risk way less. They risk probably 1%, most of them 1%, and most of them recommend not going higher, even higher than 2% of your trading account. Bear in mind, you have to have a considerable amount of capital under management. Now, the second thing that most people who are new into the trading business don't get told is that 90% of retail traders lose 90% of their trading accounts within 90 days. It's hard to last 3 months as a new trader, as a beginner. And I wish I was told that at first. I wouldn't have gone through a lot of trouble and a lot of trial and error myself. I wish I was told that, Mandla, the first thing you have to think of when you start your trading journey is survival. Survival. Because when we start as beginners, not having the necessary information, we start to jump off trying to make huge returns of over a short amount of time. And that tends to backfire 90% of the time, and you end up having 10% left of your trading account, right? So why is that? Why do many people lose 90% of their trading accounts within 90 days? Well, there might be a lot of reasons. There are a lot of reasons. Well, there was a research at FXCM, and they researched how accurate were traders out there globally. How accurate were they? And they found that 50% of the time they won their trades. So why is 90% of retail traders lose 90% of their accounts within 90 days if they win 50% of their trading accounts? It goes back to one thing: risk to reward. Some of it might be psychology, maybe cutting your losses to letting your losses run and cutting your profits too early. It does happen. It did happen to me, you know. You know when you get so erratic into the market, when a trade is on your side and you go to break even so fast, and you feel like, let me take 50% of the profits off and close my trade, and you feel good. But when you continually do that, you figure that at the end of the day, I've been risking 2 times what I've been getting, and it tends to backfire, and we tend to realize that once we have lost a lot of money. And it's hard to generate 3% and not give it back to the market when you have $100 trading account. So I recommend $100 trading account to be like a dummy account. Something that you start off with and try to learn from. It's not something that you actually are going to make a whole lot of money from. Just like my friend and partner told you, you can't expect to make $800 off of a $100 trading account in 2 months or 6 months, even a year. It's too much. It's unrealistic. So why is it hard to generate 3% and not give it back to the market with a $100 trading account? Basically, it's a small account. Let's take, for instance, let's take a $100 account. That $100 times it by the lowest position size, which is 0.01. That would give you $1. And that $1 is 1% of $100. Now that $1 is 10 pips in the market, and it's unrealistic to have an average risk of 10 pips into the market. You might get stopped out a lot of times while risking 10 pips. Say that your average risk is 30 pips, ne? So that 30 pips would be $3. And that $3 is 3% of $100. That would have to mean that you're risking 3% of your $100. So when you take considerable amount of pips that you could put on a trade, you begin to realize that you're risking more money. You're risking 3%, right? And this would have to mean that we have to risk more on a smaller account, as the lot sizes aren't in our favor. And on this section, backtesting, there's a whole lot of information that you can get from backtesting, and there's a whole lot of things that you can do with your backtesting results. But for today, I'd like for us to focus on maximum allowable drawdown. At first, I wish when I started beginning my trading journey, somebody had told me this: Mandla, focus first on your maximum allowable drawdown. That would help you get centered around risk management, and that would help you be more cautious with your trading. First, backtest results are a good guide when employing risk management. It's really that simple. When you have done your backtesting, your 100 plus trades, now you have measurements that you can employ. You can employ into the market to see whether you're having a good run into the market or not. Let's take, for instance, your maximum allowable drawdown in trades. as you can see right here, I have took some pictures of backtest the results, and as you can see right here at the section called maximum losing trades, which was 8. Say that maybe your maximum allowable drawdown in trades is 8 trades. You have lost 8 trades in a row. This would have to mean that if you lose 9 trades, something is wrong with your trading. Either something is wrong with your trading system, or something is wrong with your trading psychology, or you haven't been trading good. What's the measurement that you are going to employ to see whether you have to reevaluate your trading before you go back to the live market? Well, that's the measurement that you can employ. Our maximum allowable drawdown in trades. Now, say that maybe you have lost, your system shows that it has the ability to lose 8 trades in a row. So if you lose 7 trades, you shouldn't be more stressful about it, because you know that you still are within your maximum allowable drawdown and there's nothing wrong with your system, right? And if you lose 9 trades, that's when you have to stop and shut it down and go back to the drawing board. Now, let me show you how to calculate your maximum allowable drawdown percentage. It's really simple and very insightful, and it could help you in determining your risk tolerance. Now, let's say, for instance, you say you don't want to risk no more than 16% of your trading account before you reevaluate your trading. So that's your threshold, right? So you know that when you risk more than 16%, psychologically, maybe it might hurt you, it might fuck you over, and you might tend to make more psychological mistakes in trading. So your threshold is 16%. 16% isn't much of a large sum. So what do? Okay, this is what you do. You take your maximum losing trades, which was 8. You say times the percentage that you risk per trade. Say that you risk 2% per trade, so you are going to say 8 times 2. That would give you 16%, and that would have to mean that your maximum allowable drawdown in percentage is 16%. Say that maybe 60% isn't much of a big deal for you. You would say, well, I don't want to lose more than 25% of my trading capital. So 16% is too small for me. Say that maybe you are that person. You might say, okay, 8. Then you might try to risk 3% of your trade, 3% of your capital per trade. That would have to mean you are going to times that losing streak times 8, and that would have to give you 24%. So for 24%, after 24%, that's when you start taking necessary precautions. That's when you stop, go back to the drawing board, and reevaluate your trading. Say that you don't want to risk 16%, and you'd like to cut your losses once you exceed four trades in a row. Once you exceed losing 4 trades in a row. Say that maybe you risk 2% per trade, so that would have to mean you're risking 8%. So once you have incurred 8% of losses, you can cut down your risk. How do you do that? Now you've incurred 8%, which is $8. Okay, so we are going to say $100 minus 8, and you want to cut your losses and cut your risk and employ risk management once you reach 92. So what would happen? This is what would happen. You're going to say $92 times 2% divided by 100. So you're no longer risking 20 pips. Now you will be risking 18.4 pips. I hope you enjoyed this lesson. Let's go back to the charts. Alright, now that we are on the second part of the video, which is the charts, looking at the forecast and looking at potential trades that we might take as soon as the market opens on Monday. Okay. I was looking at a few pairs, basically few potential pairs that give me good risk to reward trades, as NZD USD and this one, which is USD Swiss. I chose to talk about the USD Swiss because it gives me a more of a basic kind of trading opportunity, which has more reward and less risk. We're looking at here. We're looking at a structured trade, and as you can see, price in the past has been resisting at this point, and it's been refusing to breach this level right here. We have a psychological level. If you have been with me for quite a while, you would have heard of me talking about psychological levels a lot of times. Psychological levels are very powerful levels which act as support and resistance. So as you can see right now, price gave us a resistance. Right here we have a false breakout into the market, okay, and then the market is trying to reach those levels. Actually, it has probed those levels, okay. So what I'm looking at is a potential selling opportunity which is occurring exactly right here. So what I'll be looking at when I go down to the lower time frame is a set of confluence into the market that would give me a good risk to reward selling opportunity. If not, then I wouldn't be looking for a selling opportunity. I would wait and sit back for a while for another opportunity. Okay, let's go to the hourly time frame. Okay, now that we have a potential resistance level right there. Let's see what the market is, what type of opportunity is the market giving us right now. Let's see. We have a potential extension. Okay, the market has extended to our 127 extension. Didn't reach our 1414 extension, and the market exactly, yeah, it has given us a 1414 127 extension, excuse me guys. And then if you could look closer, right here we have a double top, okay, actually a triple top. So what the market did is it went ebbed and flowed, gave us higher highs, higher lows, right, and then gave us some double top right here. And then as we zoom closer, we began to have a support level right here. But if you could see, this support level has been breached, right? The support has been breached, and the market has given us what guys? What has the market given us? Yep, lower low, lower close. This sets us up for a 26.18 trade. Okay, for 26.18 trade to occur, we have to have 2, which is double top. We have double top right here. We have a bearish divergence right here, and the market gave us a lower low, lower close. So we are looking for a, what are we looking for? We are looking for a 618 retracement back up. So let me zoom in closer so you can see. So we are looking for a 618 retracement back up. So if the market does give us a 618 retracement and hit this retracement, then we might be looking for a potential selling opportunity back down, at least to this level, which is our first target. Okay, and for our second target, let me remove this and tidy up a little bit. I kind of like my charts clean. Okay, I like my charts clean. Okay, it's okay. These ones, okay. Let me just do this. So, in order for us to see our second take profits, I would have to bring in my Fibonacci retracement tool. So our first take profits are at our 382, and my second take profits are at 618. So my second take profits would be at 99.54s. So 99.54s. Let me bring that tool over again. Bam. So I'll be looking to sell the market in fruition that it would hit this very same 618 retracement. Okay, so let's look at the risk to reward right there. All right. If I entered this level, I would have to go, let me see the ATR. If the ATR is constant and 7 pips, so what I would have to go 7 pips above our highs. Let's make it 10 pips. So I would have to risk 20 pips on this trade, and for my first take profits I would have to take 33 pips. Then for my second take profits I would have to have 64 pips in total.